friends. Good day to you all. How's the mic coming through? Sound check. Uno, dos, tres. Cuatro, cinco, seis. What's up, everybody? Chat is lively this morning. And here we go. Hello. Welcome, my friends, to Alpha Beta Soup. It's your boy, TXMC. The date is Thursday, January 25th, 2024. It's 11 a.m. in beautiful Austin, Texas. I hope you're all doing great today. I spent the last hour or so trying to get a data set together so that we could look at the Bitcoin ETF flows, and we will look at that together here in just a minute. I tweeted out a little preview of the chart a few minutes ago. So for the last hour and a half, I haven't really been watching the markets that closely ever since I saw the GDP report that came out a couple hours ago. It was pretty strong, about 2.5 hours ago now. And I saw some of the buzz about Twitter, but then I put that stuff away, got myself ready for the day, had some breakfast, and then I was putting this data together. So I'm going to be looking at the market with kind of fresh eyes with you guys today. We'll look at stocks and stuff like that. But yeah, it's been the ETFs have been really just kind of sucked all of the attention and air out of the room the last couple of weeks. And I've been paying a lot of attention to them. People keep asking me about them. And I've decided I thought it would be interesting for us to look at the flows in those instruments, because there's a lot of buzz about the amount of Bitcoin that they own. I think combined, all of the ETFs have hoovered up about 100,000 BTC in the first 9 days, which is not insignificant. A fair amount of that has come from Grayscale offloading. However, there's some trends underneath the buzz about the ETFs that kind of caught my eye, and we'll look at some of that together. Well, let's check in on with them. We'll check on with them first. So before I actually get started, let me do a little bit of housekeeping. Welcome to the stream. Glad to see everyone in the chat. If you haven't smashed the like button, please do that. That is your number one way to support the channel. Looking out and I see people already gifting memberships, which is incredibly generous of you. Code 9, welcome to the channel, my dude. Eric Martinson gifted a membership before we even got here today. Several of you had gifted memberships. Eric did. David also gifted another membership. David's been like our number one OG gifter. So thank you so much, David. Every week you're coming in hot. Chris also gifted a membership, and Steven just gifted 5. So there's like 10 of y'all that just joined in the last few minutes. Welcome. What that means for you is that your name is different in the chat. We're working on some emojis. Those should be here soon. So we'll have a little bit of flair in the chat for you guys to go along with what's there now. And about once a month, we do a private members stream, which is just only for subscribers. You who were just added to the channel, who were just gifted memberships, you will have access to that stream, and we will do that next week. So next week we'll do this public stream like we're doing right now, and then about 30-45 minutes after that, we'll do a private stream just for the homies where we just kind of hang out, we talk. There's not as much of an agenda. It's much more interactive, just kind of back and forth, and get to know each other a little better. So if you want to participate, be ready next week after the stream for a little private member chat. If you'd like to join that, if you don't know how it is done, you can go to the channel and there is a join button right there. I don't think you can do it on mobile. I looked for it. I can't find it, but you can go right here if you choose to do that. If not, it's all good. We'll keep doing these public streams like we're doing here. I'm TXMC. I'm just a dude on the internet. Everything you're about to hear are just my opinions based on my personal biases and research. Do not take this as financial advice. Full disclosure. So, all right, get that out of the way. let's talk a little bit about the markets. Let's talk about the ETFs. I think that'll be a good way to get my grounding since I haven't been paying as much of attention to equities just in the last couple hours. I've been putting together data for these big bad boys. And, the main thing I wanted to watch besides the price action in the first few days was the volumes. And so I have a view that I've been watching of the larger of the ETFs, of the larger half of them. And I've been watching volume, and you can see it's pretty clear on a lot of these. Oh my gosh, that's thick. You can see the volume is very gently kind of receding a bit. It isn't falling off a cliff. It's still fairly steady, but just like day to day, the dollar weighted value of the volume is falling. Now the share prices have fallen a bit, and the volume down here is the price times the shares. So that's part of the effect, but you would hope that if there was a lot of pent-up demand, as we were promised by many people before the launches, that this volume profile would look different, that it would either be holding steady in the face of falling prices or potentially even structurally increasing. But none of them are doing that. So what does that mean? Well, I mean, volume-wise, it doesn't say a whole lot because this isn't flows into the ETFs. This is shares trading hands back and forth. Net flows is who actually held the asset at the end of the day. Well, we have data on that now, and we're going to look at that together. The way I pulled this data, full transparency, I went through my Twitter, and I went through James Seifert and Eric Balkunas, the two guys who work at Bloomberg. They've been posting these net flow every day, these tables. And so I actually went through here and I copied all of this stuff manually into my own spreadsheet. Because sometimes when you're an analyst, that's what you got to do. You got to do the dirty work. And so we've come up with a couple of charts. Let's look at them together here real quick. This is total net flows to all 10 BTC ETFs. Up at the top, they're all broken out. You can see you have ARCB, BitB. BitB is the Bitwise ETF. Burr, that's the Galaxy one. And so they're all here. This is their net flows by day in millions. GBTC is in red, and they have steady outflows. And one of the things that really caught my eye about this, and one of the reasons I wanted to chart it, is because it looks like the GBTC outflows are really steady. Like they're consistently 500 to 600 million every day, pretty much. And I noticed as I've been watching these guys, these homies here posting these tables every day, one of the things that I always go to is what is the net flow of Grayscale? And every day that I look at this number, it's a number. I mean, this says 429, but pretty much every day it's been a number that started with a 5 or a 6. And that's what you can see right here. It's the numbers I kept seeing. And I was wondering, okay, well, if I see that this is pretty steady, but over here on my volume indicators, those are declining, what does that look like in terms of total flows? And if we don't look at GBTC and we just look at everything else minus that GBTC, that's them up here. And the flows are positive. They're positive, in total, in the aggregate, in the hundreds of millions. But the trend is slowing down a bit. In here, just in the last week worth of flows, these last 5 trading sessions are not as large as the first 4 trading sessions. There's like a notable step down here. And they're declining structurally. If we put these all on a chart, if we put all of these on lines together, they're these two down here. The dark gray line is everything, with GBTC included, the total daily net flows to all of the instruments. The ETFs, recall, this is not in BTC terms. This is in millions of dollars. This light gray line is all of them minus the big dog, minus GBTC. So the light gray line represents basically everything above the 0 up here, everything that's not the red bar of GBTC. All this colored stuff is down here, this light gray line at the top. That's all XGBTC. You can see the flows the first 4 days really strong. 720 million, 700 million, 540, 928. Big day on day 4. That was like the Tuesday of last week, I believe. But since then, the flows haven't gotten back to these lofty levels. They haven't gotten above 624. Meanwhile, GBTC has stayed really steady. And what that has produced in the total net flow of all 10 of them is a structural decline in net flows. And 4 of the last 5 sessions, 6 of the last 7 have all been negative outflow days on net from the total ETF complex. So there's 2 ways to look at this. On the one hand, they are scooping up spot Bitcoin at a pretty rapid rate. You know, they've acquired, I think in total, I don't have the number in front of me, but I believe as of yesterday, all 10 of them combined have hoovered up about 100 BTC on net. The new ones have, but then we know there's an exodus out of GBTC. So the net is a bit noisy, and I don't have that net figure in front of me, but in total, the amount of Bitcoin supply that sits inside of ETF products has gone up. So the total number of Bitcoin trapped inside of the ETF ecosystem has risen since the days the ETF launched, right? But 600,000 of that was already in GBTC. Some of that has left and just gone into these other instruments, and other parts of it have just left in general. Capital has just left. So on a flow basis from the ETFs, which is separate from the spot Bitcoin, they're on net negative. What people are hoping for, is that sometime in the near future, these GBTC outflows will start to taper off. And that's reasonable to expect, that they won't just do this forever. You know, GBTC came into this, they had $27 billion worth of Bitcoin. You know, they had over 600,000 BTC. They've lost 100,000 or so of that, and they still have a whole lot more. Now, some of the news stories I saw were that this was FTX selling, and that FTX already sold it all, so everything should be fine. Well, that's what people said over here. Well, it's been 2 more days of another $1 billion in outflows. So what did those people say that was wrong? Well, what those people got wrong is that FTX is not the only bankrupt estate that owns GBTC. FTX is not the only locked up holder that wanted out of that instrument. So while FTX is very popular and they have a lot of attention on them for obvious reasons, they are not the only person that matters in this. Voyager, Celsius, BlockFi, 3AC, they all had GBTC. They are all bankrupt. There are also a lot of holders, people who bought this instrument. Like, let's go look at it real quick. GBTC. GBTC has been around for a long time, right? It's been around since 2014 or something like that. There are people who've had it since back here, and they have been waiting for this moment. Some of these people are in tremendous profit, because if you just look at where they are, even though there's been this sharp pull-off, look at where they are relative to the majority of GBTC's life. People are in hella profit. Everyone except those who bought right here, which probably is some of them. Some of these people probably bailed out at break even, right? They maybe bought here, they maybe bought on the way down, maybe they bought back up on the way up in the second half of 2021, and now they're just getting out for break even. But there are a lot of people in deep profit, and they were locked into this instrument. It was a one-way trust. Your money goes in, it doesn't come back out. And now that the discount closed and the gates opened, all of those people are free to finally realize some of their capital, scratch that itch, alleviate the frustration, take care of their business, whatever they have to do. As far as the bankrupt estates go, those are fire sale liquidations. They're price insensitive. They're just trying to get out. They have to sell the asset to settle up with the courts and settle up with their like lenders and things like that. So it wasn't just FTX, and just paying attention to how much GBTC FTX still has or doesn't have won't give you the total picture of what's going on with Grayscale. They've lost, I think, about 20% of their total holdings, because I'm guessing it's 20 because 2 days ago it was like 17 or 18%. So I'm assuming that they're around 20% of what they had before has left. So they had about 600K, maybe 150, 160 BTC is left. I don't know. I don't have the number. But there's still a lot left in the trust. And it's reasonable to assume, especially since they are keeping their fee at 1.5%, while most of the others are below 0.5%. Their fee is twice as big as most of the other ETFs. As long as that dynamic exists, they will probably continue to have net outflows. Maybe they won't be this big, but the net inflows to the other ETFs are softening. So this needs to stay robust while GBTC tapers its outflows in order for this to turn around and become an overall completely positive story. Because there are a lot of positives about the ETF. This isn't all bearish. Don't misunderstand me. This is a great thing. The fact that we have all these products now, it is a mainstreaming of Bitcoin. It's not just this joke, funny internet money that people laugh about and that no one takes seriously. You have major financial institutions offering structured products on top of it. So that's a good thing. But there were a lot of promises made about what the future would look like as soon as these doors opened, and almost all of those people were wrong. And I think we need to recognize that and remember that so that those people can't do that again to us next time. They didn't do it to me, but to the mob next time. Give them a bunch of promises that are just not tethered to reality and have people be disappointed. You know, the reason people are disappointed is because expectations were through the fucking roof. This is actually a pretty successful ETF launch, all things considered. The total amount of volume, the amount of demand is very good. It's larger than most ETF launches. But because Bitcoiners are the way they are, and because crypto has so much potential in people's minds to make money, they just assume that this is something that everyone understands, everyone wants to own it, and as soon as they have the chance, they're going to flood in. And that just wasn't the case. I didn't believe that to begin with, but we actually have data now confirming that just wasn't the case, at least not in the beginning. So that's kind of the look currently on the ETFs. If we look at just the total running sum of total flows, it's 800 million in the plus. But this is what the running sum of net flows has looked like every day. After the first day, the running sum of total net flows, ins and outs, was 600 million to the plus. That's amazing. And it climbed for the first 4 days. And, you know, remember when we were talking about over here, it really looked like the first 4 days were large flows, and then the next 5 have been more muted. We haven't really gotten back to those levels. You can see that here in the running sum total. It climbed for 4 days. It's been falling for 5. And the running net sum has fallen below $1 billion now. It was above for several days, but now we're back down to 800 million in total. It would be not a great sign to see this. Ooh, that's yellow. It wouldn't be a great sign to see this go down here below this level. Like that would just suck, right? That would suck the wind out of the sails for people if the total net flows fell below what they were on day one after being such a great story. I'm not going to make a prediction about that because I frankly don't really care, but you can see the trend is kind of turning around and reversing, and it's mostly because of Grayscale. It's not because people have necessarily decided that the ETFs are bad products and they're dumping all of them. It's because Grayscale is relentless. It's because there is a relentless outflow out of this one single product, and it's currently dwarfing all of the others on inflows. So I'm going to take a sip of my drink here. Oh, spilled a little bit. I'm going to take my jacket off. Give me 1 second here. Don't drink coffee while you're doing a live stream, guys. Iced coffee. Not hot coffee, but iced coffee. Just spilled a little bit on my jacket. All right. So let's talk about the rest of the markets, I guess. So that's what's going on with the ETFs. Not really much else to say about them. I think we've broken them down pretty well. The crypto market in general built up a lot of bullish momentum into the launch. And what I think everyone in at least in the crypto space is currently watching is to see how much of a pullback we're going to get on Bitcoin and then likewise on other tokens. And price hasn't really broken down to total doomsday yet. You know, we're still just hanging out here around 39,000, right above this level here, which is kind of what I figure would get tested at some point. This just looks like This just looks like too juicy of a spot not to at least come down here and test this consolidation before the clear breakout. And I think it makes sense that we will. I don't think we're just going to turn around right here and go higher unless there's some kind of a catalyst, unless there's something that wakes people up, some kind of a news story, something like that. It makes more sense to me just from a support and resistance standpoint that we would test this level. And on the move up in 2024, where there was a lot of momentum, not just in Bitcoin, but there was an altcoin rally, right? Ethereum kind of hung behind, but we talked in past streams about other tickers that were moving higher and how we were having a bit of a mini alt season during this period. And if you look at the crypto market in terms of momentum and breadth, you can really see how we started losing steam into the launch of the ETF. So I wanted to show you some of the indicators that I look at that show me crypto breadth. I made a couple of these more recently, and some of these are older. But up here at the top, this is the total crypto market cap minus the stable coins. So it's just the assets that we actually trade and care about. And that move higher was not just Bitcoin, right? It was the whole crypto market. BTC led the way. And what we have here, so this second indicator, this one in the middle with the two lines, it says breadth MOMO. This is the momentum of top 40 coins, because TradingView lets me put up to 40 coins in a single indicator. I wish I could put the top 100, but I can only do 40. But this indicator shows the momentum inside that top 40, not including stable coins, so just actual tickers, actual symbols, of advancers versus decliners. So when this is going up, there are more symbols setting new highs versus setting new lows. And when it reverses, it's the opposite. When it goes sideways, it's kind of a break-even market. And this just kind of goes hand in hand with price action. It's kind of like a MACD for the dispersion inside of crypto. So it's on two different EMAs here. That's why you have two different lines. And the real takeaway of it is when it's going up, more and more crypto names are rising together. And when it rolls over, it means the opposite. And you can see back here at the beginning of 2023, when the market first lifted off the FTX lows, everything went with it. Everything went with it. After many months of breadth kind of chopping sideways, right? We went through this long period here after the 3AC collapse from July to November, where the crypto market just kind of went sideways. Bitcoin, Ethereum, everything just kind of went sideways. We had the ETH merge narrative in here, but other than that, not much was happening. And total crypto breadth, not much was really happening. But as soon as the beginning of the year hit, everything rose together. And even though we were chopping here, prices kept setting new highs. You can see the breadth never really took off. And this confirmed in part that calls for alt seasons inside of here were a little ahead of themselves, because we couldn't really see that in the total view of the market. But over here, as soon as we got that fake announcement in mid-October about the ETF from Cointelegraph, there was like that fake tweet, and we had this big pump right here on BTC. Ever since that day, we had a little mini alt season, and we had breadth expanding up to its highs, its secular highs. Right? These are like the high points for this indicator, which, you know, if you have this view, you could see once we got to this point, wow, we are really overextended on breadth. Like the whole market is participating here. And once we start to see it break down, almost like a stochastic RSI, once this actually breaks down from its upper boundary, that's a pretty good confirmation that the market has turned over, at least temporarily. Doesn't mean it goes all the way back down, but that the momentum has turned. These triangles down here, these white and red triangles, essentially represent the momentum of this oscillator, which itself is the momentum of the market. So when you have a bunch of a bunch of consecutive days of advancers, meaning coins that went up, outnumbering decliners, coins that went down, when you have a bunch of consecutive days in a row, this prints a streak that builds one of these triangles. So as this built up here to 25 or 26, that was 25, 26 days in a row, according to this indicator, where we had expanding breadth, where there was more coins making advances than declines. And if you zoom out, you can see the periods of chop versus the periods that were alt seasons. These are kind of, it's one way of looking at alt seasons. It's not all encompassing. And again, it's only built on the top 40 tickers. So if we had an alt season that was in like the bottom 100 coins, it probably wouldn't get represented as accurately here. But it's a way for us to just see the momentum in the market. And you can see that this move here in November, late October, early November, this streak here in crypto where we had this big pump higher after the Cointelegraph fake announcement, breadth expanded. We had a big streak of consecutive days of breadth expanding, and that matched some of the strongest periods that we've had like that in the last few years. Then momentum broke down. We zoom in on this period. We had this long streak, and as soon as that streak ended, we went through a period of chop. Momentum slowed down. It didn't continue expanding. It had reached the highs. The streak was broken, and price action confirmed those things. And then once we got to the end of the year, the ETFs were about to launch about 2 weeks out. Everyone knew that January 10th was the deadline for the ETFs. It was known. It was a public date. And that was around the time momentum just completely died. Right around the turn of the year. You know, some of it is people doing their allocations at the end of the year, some, tax loss harvesting. There's a bunch of different flows and stuff that go on at the end of the year. And then a bunch of those things stop and they turn right at the beginning of January. And right at that same time, momentum just died off. And you can see here, really before BTC ever hit its peak, all of crypto broadly had started to slow down. And we started having more coins declining versus advancing, which started to pull this down. You can see we started to build some streaks on the red side versus the white side, which is expanding. Red is declining. And it just clearly shows that the wind kind of got taken out of the sails a bit. But on the positive side, if we just look at this momentum oscillator and we compare its highs and its lows, it has done most of the trip already. Right? It's traversed most of this distance, and now it's getting close to maybe starting to find a low, maybe starting to bottom out. Maybe it does that here. Oops. Maybe it does that right here. This is the that line that I said. Maybe we bounce off of it. Maybe we come down and we test one of these. Maybe that coincides with momentum and breadth in the whole crypto complex finding a relative low. So that's one way to look at this. It's some indicators that I've been playing around with recently just to kind of get a picture of what's going on around BTC, because so much of the attention is currently on Bitcoin. And I haven't really heard, a lot of the people I follow that are traders and people that keep me informed on what's going on with other coins and things like that. They've been really quiet. It's really just been about the ETFs. And people wondering if the top was in, wondering when we were going to reverse, wondering when the supply squeeze is finally going to hit. And so I just wanted to take a moment and look at what's going on with all of BTC's redheaded stepchildren. And you can see their momentum has died off. And I think they're really waiting to see the big dog find some support here. And maybe it does, in much the same way we just had that line drawn on the total crypto cap. There's a line very similar to that on BTC. On BTC just below. So maybe we'll see that. I know some people are calling for lower, and maybe it does go lower. I don't really know. I know that some people I follow, they're looking for a move down here, right? Down to like 31. That's certainly possible. How big of a move would that be from the highs? That'd be like a 35% drawdown. That's not out of the realm of possibility. And if you look at this chart from a weekly perspective, it was really extended up here, right? Look how many weeks in a row of rising it did. That's just straight up. A little bit of chop here in this area. This is where we had our horizontal line drawn. A little bit of chop here on a daily basis. But on a weekly basis, these are all green candles all the way up to 44,000. So could it pull back? Could it fill in like all of this space right here? Maybe. I would not want that. I would not want to see BTC coming all the way down here because that's really close to this low. And if this low gets taken, I think it is lights out. It's over. just because of the structural integrity that would be violated by taking out this whole level right here. So I don't think it needs to be coming down this far. But could it get down to 30K? Could we back test the highs here? Possibly. I'm not going to try to predict that. I don't even care. Full transparency, I haven't been trading these first few weeks of the year. I've just been observing, watching. I still have my spot bags that I acquired on a bunch of different alts in mid-October. I bought into a bunch of different coins for like a swing play into the ETF launch, and I still am holding a lot of those because I don't think this move is done yet. Even though I do think it's likely that we're near the top for Bitcoin on this general macro move, I do think that there's still room left for another little pop higher. I don't know why I keep making this so thick. That's so weird. Every time I come back to this line, it's like 50 pixels thick. So, maybe we come down here and then we come up for one more pop. Don't really know. But I am kind of keeping this in mind. I think that 50K, it's likely that we test 50K. Even if I think I'm right, even if I think that it's most likely that we're near the highs for BTC on this move, if I'm correct that this is a retrace and not the beginning of a new expansion, which would be confirmed by what the economic data and the setup looks like outside of Bitcoin, that looks very late cycle. So if we're correct, then we'll find out soon enough, but that doesn't mean that we've reached necessarily the Pico top, although this really does look like a reversal setup. We talked about that last week where we went through a bunch of different tickers and we looked at, let me get rid of some of these. We went through a bunch of different tickers. Oh, I already have dollar volume on here. It must have been hidden. And we noticed all-time high dollar volume last week. We saw it on BITO, which is the futures ETF. We saw it on BITI, the inverse futures ETF, the short ETF. We saw it on the CME future, on GBTC itself, on Coinbase here. It looked like a reversal, but that might not mean that that's the Pico top for this leg. That's just a clear reversal signal, and the market was overextended. So it needs to pull back regardless just to maintain physical structural integrity. Whether that's to here or down to here or something, I really don't know. I imagine it's inside this box, and then I would expect we would go back up higher one more time. And that would corroborate a couple of other things. That would match up with oh wow, I drew that perfectly. That would match up with a 702 retracement. And that would also give things like Ethereum a chance to finish their move, because Ethereum is not up here yet. Ethereum is like down here, right? It still hasn't even really gotten up into its retracements. If we go look at Ethereum real quick. Let me find it. Here's ETH. Yeah, if we just slap some retracements on it, ETH hasn't even gotten to its 0.5. Bitcoin swept its 618. So if BTC is going to do this, if it's going to do something like this, and then work its way back up and then do like one more little sweep or something, excuse my squiggles, that would allow Ethereum to catch back up and maybe sweep this high. Oops. Maybe sweep this high the same way that Bitcoin did. Something along those lines, or at least get up into its retracements so that it has a logical stopping place, because this is kind of no man's land. This is kind of the middle of nowhere. It would just be very strange for Bitcoin to have been so strong and for so many other parts of crypto to have had such a big move off their lows, and for Ethereum to just be done here at its 382. I just don't think that's likely. So that's why I see this possible scenario playing out. And if BTC goes up, and it hits the 702, that's right around $53,000, $53,050. And don't look now. We've talked about this before, and if you guys watch my buddy's channel, Blockchain Backer, he's shown you guys this before. He and I were talking when we both noticed this at the same time. The 702 retracement is literally the 1 trillion market cap. Isn't that freaking crazy? Look at that. It's to a T. If I put the numbers on here, it's got 2 zeros on it. 1.003 trillion market cap is the 702. Literally 1.0 trillion is the 702 retracement. If you were to draw in your mind's eye, the most attractive fake out level for a retracement in Bitcoin's fucking history, it would be after a bear market where we had crypto winter and a bunch of collapsing lending institutions, 2022, a 200% rip in 2023 into spot ETF approvals, a fake out reversal that makes everyone think it's over, only for it to turn around and reverse higher. Everyone says, oh shit, it's a new bull market. I told you guys. ETFs, they scooped up all the supply. We're finally getting the supply squeeze. Everything's going great. The economy is continuing to do well. GDP was 3%. The Fed's going to print soon. Hell yeah, dude. Look, Bitcoin's $1 trillion market cap again. We're right back. Everyone's back. Everyone's in profit. Nation states are adopting. Institutions will defend their cost bases. We're all on the same team. Let's go. I don't know. This setup has my spidey senses tingling. And it's not just because of BTC. It's because the technicals are setting up for this while the fundamental data about the economy is also setting up for a rug pull. I feel like a broken record, and I feel like I'm at a stage, and I was at one of these stages last year, about a year ago, actually. I was at one of these stages where I started to feel like, because the data is so conflicted right now, the audience, my audience, not necessarily you folks here listening to me right this second, but just my broad audience, like on Twitter, like the 80,000 people on Twitter that follow me, started to feel like the audience is not listening to me anymore. Because I've been saying kind of the same thing for a while. I've been very consistent, and I've been talking about this time period right now. But because I've been talking about it for so long, the people who don't pay that close of attention to me, I'm just kind of sounding like a broken record to them. I sound like the boy who cried wolf. And I can't emphasize enough that the setup, the macroeconomic setup for 2024 and 25 is such a beast. And it's set up all of last year where we haven't seen the debt edifice roll at the current cost of money. We've talked about this on the stream in the past quite a bit. I've shown you guys that chart of the Fed funds rate and the delta between how many cuts the market actually needs and how many cuts the Fed is projected to get, and what the market probably actually needs to be given in order for it to continue functioning. All three of those are different values. That is completely underappreciated. I don't think anyone really gets it. Lacey Hunt got it, and when I told him about it, he agreed with me. Whenever I've talked about this with people in TradFi one-on-one, which has only been a couple of people, they agree with me. This setup is a doozy. Because they printed so much money, and because they have so many tools to kind of keep the economy floating, they've created just a beast of an economy. I mean, if you look at the GDP report today, it looks insane. Considering that the Fed did what they did to interest rates, and it has had almost no measurable impact on real GDP growth, is shocking for people. Unfortunately, from my perspective, that doesn't mean that the economy is okay. That means that we are caught in a very precarious window between what they have done and it actually bleeding into the economy. There's a lag. There is an input lag to the change of policy. That change of policy used to happen more quickly. In generations past, in the 60s, in the 70s, and the 80s, when the Federal Reserve would change interest rates in order to alter the trajectory of the economy, particularly when they would raise rates, it would have a quicker impact on the economy because the majority of credit in the past came out of banks. The vast majority of the credit creation came from commercial banks. And in the years since the great financial crisis, credit creation out of the banks has slowed down a whole lot. I don't know if I'll be able to capture it on here quite as well, but no, this is not showing it. Let's see, loans. Let me pull up a chart. Loans. There it is. All right. This doesn't quite capture my point as well as I would hope. That's okay. We'll just go with it. So this is total loan creation year over year from commercial banks. And back in the 60s and 70s, when we had a lot of inflation, we had a lot of loan creation, a lot of credit creation feeding a lot of those things. There were a lot of, new households were forming. The boomer generation had come of age. They were all demanding new houses. They were forming their careers. They were having children. They were spending a lot of money. There was a lot of organic demand in the economy. And almost all credit creation came out of commercial banks. And so when the Fed would raise interest rates, it would immediately impact the flow of credit, and that would, in short order, feed through into labor and to spending and into the economy. Those linkages still exist today, but they are slower and they're more obfuscated. And part of that is because if you just look at the rate of change of credit over here compared to the past, look how much lower it is. It's not because we don't have a lot of credit. It's not because we're not an overly indebted nation. We absolutely are. It's because the banks aren't creating all of the credit like they used to. They, as a total share of all loans that exist, they have less and less of a share of it. And the private markets are creating a bunch of those things. And they are opaque. They have other methods to keep themselves afloat. They have more creative ways of lending to their customers. And they're not under the purview, under the regulation of the Federal Reserve, the way that these banks are. Commercial banks are under the purview of the Fed. They are the ones that are regulated. But private markets are not. Private lenders are not regulated in that same way. But they're allowed to create credit, and they do so willingly. And ever since the GFC, when the regulators cracked down on the commercial banks and their ability to make riskier loans, all that did was it pushed a lot of that behavior out of the commercial banks. It didn't stop it from happening. Prohibition never works. When they banned alcohol in the 20s, people just made it away from the eyes of regulators, right? Didn't stop them from doing it. Same thing here, exact same thing here. And because of that, the linkage between the Fed changing rates and those rates actually manifesting into margins for businesses and households takes longer. It will happen, and it is happening, but it takes longer. And when you think about all of the excess savings that we created after COVID, we sent a couple $1 trillion to people, just rained it down upon them. We had a PPP loan program for businesses that was $1 trillion that was almost entirely forgiven. That was money that was just rained down upon people. The Fed was running quantitative easing until February of 2022, 1 month before they raised rates. They were still buying, $30-60 billion a month in treasuries and mortgage-backed securities. And they created a massive cushion that could absorb the blow of them raising rates in the way that they did. But they didn't stop it forever. They can't make it go away forever. It's just a longer delay. And we're in a very weird time frame right now. It's this chart here. We're in a weird time frame here where this raising of rates happened very quickly. But the economy hasn't caught up to this level. The economy meaning borrowers, meaning debt that's owned by corporates, debt that's owned by households. They're still largely living down here, as we've discussed at length. And if you just look at the news, you see the behavior of entities avoiding participating in this cost of capital. No one wants to sell their existing homes. Existing home sales plummeted last year. Entities are not refinancing. If you look at the private markets, they're taking out loans like payment in kind loans, which allow them to defer interest off into the future. That's something we've talked about quite a bit on here. We've read some of these stories together. And when you look at the pricing of interest rate cuts by the market for this year, they are expecting to get a lot of cuts. And because they are expecting to get a lot of cuts, no one wants to roll their debts yet. They're hoping that by the time they do, that price tag will be lower, that they'll be able to catch a sale, because this is not an attractive price for them. You know, they need financing costs to be brought back down because they still live in this world. And now with growth, consumption growth is still positive, but it's not what it was a year and a half ago. It has slowed down. Those pressures will start to manifest over time, especially now that we just got a scorching hot GDP print. Let's go look at what the number was today. I think it was 3%. Yeah. Yeah, advanced GDP, 3.3% when it was expected to be 2%. It just blew out expectations. Do you think that that raises or lowers the likelihood of the Fed cutting rates as much as the market thinks this year? It lowers those odds. It doesn't remove them entirely. I imagine the Fed will cut at some point. They will cut some amount more than zero. But will they do what the market thinks? Probably not. Everyone was wrong about cuts to the upside last year. It's likely that they will be wrong about cuts to the downside this year. So we'll find out. But the interesting thing is just how strong the U.S. economy currently is, even though rates of change in the labor market have slowed way down. It's the balancing act that I've talked to you guys about quite a bit. And it gets harder for me to articulate these views because unless you have been following my analysis all this time, I start to maybe sound like someone who just doesn't want to acknowledge reality, you know? This guy still sounds bearish, but we just had 3.3% GDP. I mean, look, I get it. It's very strong. And we would expect those things to be strong until they're just not anymore. What concerns me is the number of different data points that are all in concerning rates of change. And some of them have passed absolute levels that are concerning, particularly on the cyclical parts of the economy that tend to lead weakness, and some of the more peripheral parts of labor that tend to lead the economy. You know, things like part-time workers, the amount of overtime hours people work, temporary help. All of those things have completely pivoted their rates of change from 2 years ago. Top-line job growth has slowed way down, as we've looked at a bit together. Where is that chart? Here it is. Top-line job growth has slowed way down. And where it is now is just slightly below the average from between the GFC and COVID. It's right at it, but it's just slightly below that average after slowing way down. And I think the question that I'm asking myself, at least as far as the job numbers go, is it possible for it to just do this? Is it possible for it to just go sideways? Let me make this red so you can see it better. Is it possible for jobs to just do this? Because right now the trajectory is for them to keep going down. The trajectory is certainly not for them to turn around and go higher. If anything, the last few years have shown us that's probably not what we have in store. So will we have just slowed down and our job is just going to go like this now? I don't really know. But what I do know is that on a rate of change basis, where is it? Here? On a rate of change basis, it still doesn't look good. The trend is, see, here's the trend of all recessions here, right? Here's where we are. Look at the black line. Here's the black line, and it's breaking down. It's following the gray line. It's not following 1966. Will it just do this? Like forever, in perpetuity? Because that's what it has to do in order for us to avoid a recession after slowing down this much. The odds still favor the particular outcome. It isn't a lock. Nothing's ever a lock. But this is definitely a tricky day for folks like myself that have a particular feeling about the way this year is likely to play out, because we just got some strong economic figures. Jobless claims remain pretty low, but there are a lot of other things that to be concerned about. And I think trying to like split those down the middle is really tricky. And the job stuff, man, the job market is such a mess right now. I'm going to show you something from Mike Green from yesterday. Where is his tweet from yesterday? Mike Green, where is your tweet, bro? Okay, I'll look up Anna Wong, because she's the person he tweeted from. Anna Wong, economist. Here she is. Something about job claims that I wanted to find. Here we go. Jobless claims are very low. Less unemployed people are applying for jobless claims, meaning less people are filing for unemployment, meaning that a low level of jobless claims doesn't mean what it used to mean. We highlight two reasons why unemployed people aren't applying for claims. One, eligibility is at an all-time low before a recession. Eligibility means you had a job that qualifies you for unemployment. You had a W-2, or you had a job that qualifies for benefits. You had it in a relatively recent period of time. And I think there's certain states that have stipulations about how you were let go and whether or not that qualifies you. There isn't a national rule on it. It's state by state. But right now there is a low amount relative to history of people eligible for unemployment, in part because a lot of people work gig work, and those jobs don't qualify you for unemployment. If you were self-employed, that doesn't qualify you for unemployment. There's a lot of these like weird caveats, and right now there's a lot of people that fit into those caveat buckets relative to the past. So the eligibility rate, like the number of people without jobs who could ask for unemployment, is low relative to history. So that in and of itself will mute the total number of jobless claims. Number two, benefits not catching up with inflation. The opportunity cost of collecting benefits is higher than ever before. What that means is if you file for jobless claims, if you file for jobless benefits, if you get a job, then you no longer get those benefits, right? So you either have a job or you get unemployment. Now, three years ago, when we had the boost to unemployment benefits, there were people making more money being unemployed than they did at their jobs beforehand. And so it kept them afloat. But because of the inflation we had the last 2 years, unemployment benefits have not caught up to that. So at the beginning of last year, Social Security got a 9% cost of living adjustment because of CPI. This year, I think it was like 3.5%. The unemployment benefits have not gotten that same boon. They're still lagging behind. I don't know what the number is, but they haven't gotten that adjustment. And so unemployment just doesn't cut it for a lot of people. So they're just not filling out the fucking forms. They're just going and getting some other gig job somewhere, some other part-time job. They're working for Uber Eats or something like that. So those create interesting dynamics that are contemporary, meaning they are for this era specifically. They're not dynamics that we've had to deal with in the past. And they may partly explain why we still see unemployment claims being so low, despite the fact that you all know here on the channel, as we've looked at quite a bit, that various components of labor have already jumped up into concerning levels. Some of them have started to slow and pull back a little bit, like total unemployed persons is growing, but the rate is chopping around, whereas temporary workers just continues to go the wrong direction, right? Vacancy rates continue to contract, etc. So I think that it's really hard to read the jobs market right now because there's a lot of these weird nuances, you know? And another thing that I saw, let's see, Econ Parker Ross, where is he? Then there was one other thing to go along with that was this chart. So there's something called the SOM rule. up here, SAM, S-A-H-M. We've talked about that before. That is an economist, and she developed this. This rule was named after her, and the rule states that when unemployment rises 0.5% off of its cyclical low on a moving average basis, when it rises 0.5%, that is usually the beginning of a recession. That usually confirms, I should say, usually confirms a recession. Unemployment doesn't usually rise a full 0.5 percentage point unless there's a recession. And that you can take that back 70 years to the bank. That's a very consistent thing. And part of that reason is because job losses are the recession. They're synonymous. So when people are losing jobs, we have a recession. Those go together. Well, this is a breakout of all 50 states individually and how they compare to this SAM rule, which is a national rule. It's not a rule that gets applied to every state, but we can look at every state and we could see how many states on their own basis of unemployment have broken the SAM rule. And right now, it's over 30 of the states. 37, 39% of the states, that's so a third of them, have broken the SAM rule in terms of the rate of change of unemployment within the state. That's a level, this 30 level is a level that we've been at for recessions going back to 1980 recession right here. So that's a consistent pattern, and we are now above that. If you marry that with the dynamic we just talked about where claims are likely muted because there are factors that just make it unappealing for people, either they can't apply because they aren't eligible because they didn't have the right kind of job beforehand, or the benefits just aren't good enough for them to justify it, so they just don't fill out the form. And you combine that with this rate of change here, and then we go and we look at these labor components and then flashing warning signs. And then I also go look over here at what we were just looking at together with the slowdown in jobs. It hasn't changed anything for me. I show this to you guys so you can see that I'm not just clutching to a dying bias. The data still supports it, and we still have ample examples out in front of us of negative outcomes, depending on the anchor that you use. If you use the yield curve as an anchor, which is just one of many potential anchors, there are still 3 or 4 examples of recession ahead of us, 3 according to this chart. If you use it based on Fed tightening, on them actually raising rates, then we've got 8 or 9. What is this? 1, 2, 3, 4, 5, 6, 7 recessions out ahead of us currently that began deeper into a tightening cycle. And this includes Fed easing. This is from the first Fed interest rate hike to the end of all of these cycles, which for the vast majority of them is after the recession is over. So there is no reason to abandon this bias in the face of a strong GDP number. The GDP figure is excellent, and markets are going higher in response to those things. That's wonderful. But I haven't changed my bias because I don't have any reason to yet. And what I still suspect is very, very likely is that equity markets are making a new high before breaking down exactly the way that Bitcoin did in 2021. I think we're repeating that same fractal. And from a secular perspective, from a big time, zoomed out perspective, the NASDAQ is less than 2% away from a full Fibonacci extension off of the tech bubble. So what reason do I have for abandoning everything that I've analyzed up to this point when the setup could not be more clear? We have building euphoria in equity markets. I mean, just look at Nvidia, guys. Look at that. Look at it on a daily chart. There are people looking at this and just going, yeah, strong fundamentals. It's a great company. Makes sense, doesn't it? There's people legitimately telling themselves this when this stock has done a 6x since a year ago. And it's now one of the 5, most valuable companies on earth. This feels like a euphoric move. And the weird thing about it is that this is quite isolated. Like the Russell doesn't look like that, right? This is the lowest 2,000 companies in the stock market. It does not look like the NASDAQ, right? It's living a very different world. It swept a 1.5 year high right here, and it's broken down. I don't know if it goes higher from here, but it isn't responding in the same way the mega caps are. And in large part, that's because there's like 2 or 3 names really driving this. Nvidia is currently only up 0.77% today, but look at the move the last few days. And Microsoft as well, Meta, Google, they're all pushing higher. But if we look at, let's see, if you look at the equal weighted index for the S&P, it doesn't look the same. It doesn't look the same. Here is the S&P. Here is the equal weighted index. Look at them. So I go back and forth. They don't look the same. This is a concentration bubble. And we've been watching it play out for the last year. Doesn't mean that it can't keep playing out for a little bit longer. But what it does mean, in my opinion, is that this is a dislocation, that this is not a healthy market. We still have the number of stocks in the S&P that trade. Let's turn off this. We got the 50 and the 200-day moving average here, right? These are the number of stocks above said moving averages, the 50 or the 200. That has rolled over while the S&P has gone higher. The breadth is thinning while the S&P pushes higher. It's not a healthy market. It's not a healthy look. So while I am glad to see this, and while I still have some stock exposure that is benefiting from this, I won't lie to you. I'll be honest. I started buying, I added to some of my puts. I've got late 2024 puts on Google, Microsoft, Nvidia, and Apple. If they expire worthless, that's fine because they're the exposure to them is a very small percentage of my total net long position, but they're a hedge. It's the only way for me to feel good about looking at all of this economic data and seeing the markets continue to climb thanks to a few very excited tech names. So I have puts on those tech names. I still have net long exposure, and I will try to hold those positions as long as I can. The puts, I'm just going to hopefully sell them close to expiry for a profit. If they become worthless, so be it. That's fine. I'm willing to allow that to happen because if I'm correct, they will cushion me from any of my losses if I'm not able to exit my net long positioning in time. So that's how I'm thinking about it. I still have all those crypto bags I told you guys about. I took 10% of them off the table when we got up into the high 40s right before the ETF launched, right around the time the ETF launched. I can't remember which day exactly. I told you guys about that on stream. But I still have 90% of those original positions that I put on from mid-October. I have some long-term spot bag in Bitcoin that I won't sell that's in a cold wallet. But I'm just talking about the positions I will actually manage. Those things are still net long, and I'm going to hold them net long until either I see a high time frame, like weekly, monthly reversal signal on equities that is similar in clarity to the reversal signal that was printed here on Bitcoin. It doesn't have to look just like this, but this was a clear reversal on high volume across multiple instruments, sweeping a 2-year high at the 618 retracement. It was picture perfect. So if something else like that lines up again, perhaps a sweep of the 4.236 extension over here. If it sweeps this and then maybe the weekly looks like a swing failure or something like that, maybe I'll unload a little bit more of my longs. It'll kind of depend. I'm not trying to catch the wick high of the secular market. I'm just trying to see if I'm right or not. And I don't want to lose a bunch of money being wrong. So I'm holding my longs as we are here at the highs, I have added to puts because that makes sense. Frankly, if you are long these markets and you are seeing this and you are not protecting yourself to your downside, or at least not mitigating your long exposure, at least managing it, then you're not doing yourself a service. You're not managing your portfolio the correct way. When you are at all-time highs and downside protection is the cheapest that it has ever been, you fucking protect yourself. That is what a mature investor does. So I am trying to play the role and I am acting the part. That's what I'm doing. Let's see what Tesla. I saw someone mention Tesla in the chat. Let's look at it. Woo! Look at that. You can see I had drawn some lines here. I was watching this wedge form, and we've now completely broken it. The measured move on the wedge is playing out. What a breakdown on Tesla. I don't have a position on Tesla. I've actually never once traded Tesla in my whole life. Never owned it, never traded it, never had a product with it in there, except for my total index fund in my 401k. But yeah, that's pretty ugly. And the thing about Tesla, just like a sidebar, they have tough sledding ahead because one of the things they could hang their hats on was being the producer of the most cars last year. Well, now BYD, the Chinese EV manufacturer, they made more cars than Tesla did last year. Then Tesla, they did all the price cuts. Last year, they cut their prices 25-30% after raising them in 2022. So they kind of cut, if I recall, they gave back most of those price rises last year and might have even gone below them. And then their earnings come out yesterday, triple miss on EPS, miss on revenue, miss on margins. And then they say growth for 2024 will be, quote, notably lower, end quote, notably lower. That's not a good look for the world's most valuable car maker. I don't have a bias about Tesla. I don't really care, but that was not a good earnings report. So it makes sense that they're getting their ass kicked today. All right. I've been ranting here for like an hour, kind of going all over the map. Let me take a sip of my beverage. Let me catch up with you guys in the chat, and then we'll take it from there. If you are here joining late and you have not hit the like button, smash that like button. I have 114 likes and about 180 viewers. So if you can catch up those two numbers with each other, that would be amazing for me. Looking back in the chat, we've got a few people who have gifted memberships. Oh my God. Brandon Hammond gifted a membership. Eric Martinson gifting a whole grip of memberships. Thank you, brothers. You guys are awesome. Always here supporting me. Very generous. I love you guys. Michael Love also became a member of the channel. And the Thin King. The Thin King. Welcome, everyone. Just as a reminder, if you are a member of the channel, which looking in the chat, most of you are, if you would like to participate in the members stream, it will be next week. So next Thursday, Friday, whenever we do our stream like we're doing right now, we'll do that. We'll wrap up. We'll give ourselves between 30 minutes and an hour, and then we'll do a member stream. So that will be next week. Keep your calendars open for that. I won't book it though. I won't put it on the calendar, on the YouTube calendar, until we finish the stream next week, because I want to know when to set the start time. So that's how we'll do it. But just know that next week we'll do a member stream. Soup Crew, what up? I've been talking with an artist to get us some better chat emojis, a couple of them. I'm open to suggestions, but we'll just throw a couple more pieces of flair out there just to make it a little more fun for you guys in the chat, so I can try to give back a little bit to y'all for being so generous in gifting to me. So thank you so much. I've got a few people asking me questions in the chat. Let me see if I can catch up with some of you guys since you're asking me things. Let's see. Thin King says, how do I join on mobile? Looks like you figured it out. I don't think you can join on mobile. Your friendly NP. Love your work, Alpha Beta. Keep doing what you're doing. Thank you. Thank you so much. Just doing my own personal research. I have no bags that I'm trying to sell you. I don't have anyone influencing my content. and just trying to get my thoughts out there. I need to express them so that they don't stay in my head all the time. And I appreciate you guys giving me a platform to do that. Mike Freeman just received an email that I was gifted a membership. That means Alpha Beta Live is on. Welcome, Mike. Welcome. Excellent. Is BTC forming a cup and handle, says Eric Martinson. I don't know, dude. I don't ever look at cup and handles. Is it a cup and handle? Maybe. That's not my bias. Maybe it's maybe this is the cup and handle. Huh? Maybe we're going to negative 2,000, guys. Oops. All right. Intuitive Guy says it shows possible local bottoms. Very nice indicator. Yeah, dude, I love this thing. I love these indicators. I've debated sharing them. The reason I haven't yet is because it makes the code public, and I just wouldn't want someone else to just rip off all my alpha. You know, these are things that we look at together here. So that was my only real hesitation, but I might still do that. I'm still thinking through how to share them, because once you share them, the code becomes public. And that's not a big deal, but I worked hard to build these things, and so I didn't want to just throw them out into the public domain yet necessarily. But we might do that. One thing I did want to show, I didn't touch on this when we were looking at the breadth and we were looking at the breakdown of momentum in crypto. One thing I didn't touch on was this one on the bottom here, which is just kind of correct. It just adds to what we already see above. And this shows you the percentage gains of all the different coins that are inside the top 40. And so the high wick each day, the high wick is the highest percent gain of whatever coins were inside there. If you go over here to this day in July, right here, this was XRP. Right here. It went up 74% on a single calendar day. You know how the days roll over at like 5 p.m. So it might have been slightly different from that. But this was XRP setting the high wick on this given day. The low wick is likewise the lowest drawdown of whatever coins are in the top 40. And the size of the candle body is the distribution inside there. It's the middle 80%. So the 90th percentile to the 10th percentile, the middle 80% of all of the coins in the top 40. So if it's blue, that means more coins went up. If it's red, more coins went down. If it's above zero, then the majority of them had a positive gain. And so it's just a corroboration of these things up here. You couldn't use just this. It's a dispersion metric. But the thing about it that I like, what I think is interesting, is you can see, let me get this on the screen. All right, I'm going to close this up. You can see this on the screen here where we had the run up. This was mid-October, right? This is when the altcoin rally started. We pushed up and then we consolidated, then we pushed up again. And during this period here, we had mostly blue candles here. But then right around the time that momentum started to slow down, we started having a lot more red candles. And the general collection of the dispersion, it started to drift. It started to drift down, right? Like we had a bunch of wicks up here. We had a bunch of bodies elevated above the median line. And then it all just kind of took a step down. We started having red candles. The wicks started getting a little bit lower. And you could just see the step function of the whole market drop down a little bit right here. And that happened when the momentum rolled over, and it was before we actually got to the high. It was like right before the turn of the year. Just kind of interesting thing to look at. Brandon says, okay, I finally have a question. What is corporate debt? What exactly do they owe on, and why is it not a fixed rate for a long period of time like a residential mortgage? What is corporate debt? Corporations issue debt. So when a corporation when a business, an entity, wants to acquire more capital because either they want to build out a new facility, or they want to make some investments, or because they need capital liquidity in order to stay afloat and like pay their employees, or whatever their reason is, A business decides that they need to access some capital. This happens in every business around the world. Businesses don't just operate on free cash flows. They also operate on debt, and they issue bonds. And depending on your credit rating, it determines which market you can issue your bonds in and what kind of a spread the yield on that is relative to the benchmark, which is the US 10-year. So there's high yield corporate bond market, there's an investment grade corporate bond market, and those trade. And people, when I say people, I mean firms and institutions and pensions and hedge funds and banks and shadow lenders, the whole crew of financial institutions. They trade those things. They buy companies' debts, they trade those debts, they hold them as assets, etc. And it's a whole market, the same way that governments issue debt to pay their deficits, to pay their budgets, and other entities buy that debt. It's exactly the same thing. They're just corporations instead of sovereigns. And corporations need credit. They need access to credit. It allows them optionality. It allows them not to have to sell assets in order to create liquidity for themselves. They could just issue debt. They could issue it against equity. They could issue it against the collateral value of a basket of things that they own. It's a bunch of different structures. It depends on who's lending to them. Hope I was able to answer that question for you. I ask this because you talk about it, but I don't understand why they would all be refinancing this year. What are they refinancing and why this year? So when you issue a debt, it has a duration on it, right? You could issue a 5-year note or a 10-year note, or you could issue some short-term debt or whatever, right? And there's various factors that influence those things, depending on what it's for, how long you think it'll be before you pay it back, what the yield will be. Like I don't issue corporate debt, so I can't tell you all that stuff. But there's a bunch of factors that go into what that is. But there is a constant where every month, every quarter, there are some businesses who issued debt in the past, and if they would like that credit line to continue to be available to them, or they're still paying down that debt, but maybe the terms are up for renegotiation or something along those lines, they have to refinance. And in many cases, when you refinance at today's costs. And so because of that, because rates changed so much, right? Because of that chart that we looked at together that I posted the other day. Where is it? Because of this, right? The cost is now up here, but the current debts they're holding have yields down here. And they don't want to pay this rate. They want to pay this rate because that is what their business is built around. And their costs will potentially double just to access that same credit line. Just to get the same amount of debt issued again, the cost could be considerably higher. It could be 200, 300 basis points higher than it was last time. And so businesses are trying to avoid that. And that's the stories we read where private lenders are allowing them to defer their interest payments by taking out a new loan to pay the old loans. So it's becoming like a Ponzi-nomic stack of plates here. And businesses are trying not to join this cost, to join the new cost of money. They're hoping that rates come down a whole lot before they have to tap additional credit, or they will have to make tough decisions. Either they cut costs, which could mean cutting labor, or they fire sell some assets, have some distressed sales just in order to get some money, or they have to start handing in the keys to various pieces of property, or they skip a debt payment and just outright default. All of those are potential options. And most of them are not very attractive at the current cost of money. Marco says that I think a retrace would register such strong readings on momentum indicators. Yeah. Yes, absolutely, I did. Especially because of how long it's been. So You know, a retracement does have strong momentum. There's a history of that with Bitcoin, of retracements having strong momentum. This one right here, right? If we just forget 2020, forget the prior bull run, and we go back to 2018 through 2020, this run right here was incredibly strong, and it reached the same retracement. It reached the 618, which is what we just hit on the launch of the ETFs. And this was a really swift move. It had strong momentum. The MACD was going higher. We had high volumes. So yeah, you can get that kind of a sharp move. And the reason I think it makes this one so dangerous here is because we've got this heady economic setup, as we've looked at quite a bit together. But we're now deep into the territory that cycle theorists would consider the next cycle, right? They considered the bear market to have ended right here. And we are now putting in the fractal that defines the beginning of the bear market if you are a 4-year cycle theorist in crypto or Bitcoin. And that's something I've tweeted quite a bit about, how I even said this down here at the lows. Let me find the tweet for you so I can just like read my tweet. From TXMC Trades, Patterns, Endure. Yeah. I said this to Checkmate in March of 2023. By every idiosyncratic lens, by every lens that only relates to Bitcoin, Bitcoin has fully established its bear market floor, everything triggered. What is uncertain is whether the economy will allow those cyclical patterns to endure. So this has been my belief the whole time. Bitcoin absolutely bottomed here. If we were to go through the compendium of on-chain metrics, they would confirm that this was the low, that this period of time here was the definition of the cyclical low from the perspective of Bitcoin on-chain cycles. And so this is the beginning of a new fractal, right? In the minds of the majority of participants here, this is the beginning of a new cycle, not a retracement off of this cycle, because of the distance, the duration, and the signals that triggered at the lows. People have moved on from the 2021-2022 cycle. It's over in their minds. I take the tact that this is a cycle still, and that this is a retracement from this. And I think because it has taken so long, and because we have these catalysts now, that it's almost just a laughable concept, I think, for a lot of people. They would maybe find it laughable, what I just said. That this is the retracement at the end of a secular cycle, not the beginning of a new cycle. That is yet to be determined, but that will remain my bias until it is plainly invalidated. Catching up with the chat. BCB and TXMC win combined stream, says Dejan. Yeah, that's a good question. He and I should do a stream, or at least maybe a Twitter space or something sometime soon-ish. We haven't done one together in a while. It's been a few months. The last time we did anything together was a Twitter space. Last year, he joined me on a Twitter space. We talked for a couple hours. We'll see. I'll talk to him about it. We'll see how it goes. TXMC, could you break down what your employment composite shows? Yes, I'd be happy to show you what that is. So let me go to that chart. It's this one. It's this one. It's this one. Sorry. I don't name my charts very well here in my workbook. So this is called employment composite. It's just 2 lines. There are 2 measures of employment, okay? There is total non-farm payrolls, and then there is the household survey, which is called employment level. And they are both measures of the workforce. Let me just put them on a chart together so you can see them. You can see how they're pretty much the same thing. Okay. Here they are. Go back to the 40s. They are the same thing. They're two different surveys of the same pool of people, which is the U.S. labor force. They both show about 160 million people. They are different. One of them is the establishment. It's sometimes called the establishment survey, and that is the non-farm payrolls number. When you hear the jobs report and they say 200,000 jobs were added in December, it's this number that they are reading to you, total non-farm payrolls. The employment level is called the household survey. It asks a different group of people. This asks businesses. This asks people about their jobs. And so they come up with slightly different numbers. The employment level is more volatile. It chops around more. You can see it's more wiggly, whereas the red line is more smooth. And what I do is I just average the two. So my employment composite is literally just splitting these two right down the middle. And over here is that figure on a rate of change basis, a 6-month annualized rate. Every rate of change that I use in my workbook is a 6-month annualized rate. It's faster than year over year. It's not as noisy as a 3-month annualized rate. So I chose 6-month, and I do everything that way so that I'm comparing apples to apples. All right. Now let me keep catching up with the chat. Oh, wow, gifting some memberships. I'm seeing the memberships being gifted out. Man, I really appreciate you guys. Got 177 of y'all hanging in here right now. That's really solid. You know, we've been keeping those numbers pretty steady every time. David says, is Nvidia up because it's making the #1 engine driving the AI revolution? Well, I mean, that's what people say. But that is true. However, what is this AI revolution? What is it? Is it a clever language model that a bunch of businesses have now plugged into the API for? Because that's what I see. I see very few applications of true artificially intelligent software. We will get there, I have no doubt. But are we there yet? I don't think so. What I see is a clever wrapper over a search engine, which is what ChatGPT is. And most of these businesses that are incorporating AI have plugged into the ChatGPT API or something along those lines. So I think that this is the first iteration of AI, just like the tech bubble was the first iteration of the internet. The internet still went on to change the world, but it wasn't ready to as soon as the market wanted it. And I think we're doing the same thing right now with AI. And Nvidia is priced to perfection. They're priced at 200 times earnings. Like literally everything has to go perfectly right to justify what they were at already before the latest move added another 400 billion or whatever to their market, whatever it did, added a couple hundred billion to their market cap. So, the story is very powerful right now, but I would argue that reality is far behind the actual story of what AI is delivering. And when I see that kind of a difference, that kind of a delta, I just don't want to get involved. I'd rather wait until it is a clear value buy. If you already have a position in Nvidia, good for you. Make that money. Please do. No jealousy here. Make your money. I just wouldn't get swept up in the stories people tell. All right. Catching up on the chat. People mentioning Tesla, so I know we're getting near the end here. Professor Loki Crypto donated. My crypto brother, keep doing great things. Wow, what an amazing, very generous donation. Thank you so much. Thank you. What desktop app do you use to check the net inflows and outflows by ticker? First time I've seen that. So I mentioned this at the beginning of the stream. There are two guys on Twitter, James Seifert here, who works for Bloomberg, and Eric Balchunas, who also works for Bloomberg. And these two gentlemen have been posting this table every day that shows the flows to the different instruments, day 9 flows. So I just, like a degenerate, I opened them all. I went back in time and I opened them all, and I put them in a spreadsheet for myself. And then I made a chart with that spreadsheet. That's all I did. And I came up with this. So I don't have any special plug-in. Their data comes from the Bloomberg terminal, which is like $20,000 a year, and I don't have one of those. So I did it the old-fashioned way. I copied their numbers, and their numbers show this right here. And the reason I wanted to copy it, the reason I found it important to do this, is because they, every day, are just tweeting the day's flows and the total flows and commenting, well, today was an outflow day. But I remember what they said yesterday, and I remember what they said the day before and the day before that, and they've had multiple days of outflows. But no one is acknowledging that. I haven't seen anyone tweeting out, this is the 4th day out of 5 and the 6th day out of 7 that we have had negative outflows, which you can see here. Or the 5th, 5th day out of 7, the 4th day out of the last 5, that we've had net negative outflows, net negative flows to the ETFs, net outflows. I haven't seen anyone making this point. The only point I see people making is this one. Update today, 900 million net inflows. And then the very next day, update, 800 million net inflows, but no acknowledgement of the fact that it fell 160 million day over day. So I needed to chart that. I needed to share that because that angle was not being covered. So that was what motivated me to do it. And you can see the trend is not our friend. This is the running sum. It rose for 4 days, fell, recovered a little bit, and then has fallen 4 days in a row. And not only is it falling because GBTC is remaining steady, but because the flows into the other instruments are flagging. They're falling structurally. This is a structural decline. Look at it. And I'm not trying to make a huge point of this. I just want your eyes to see what might see. And what I see here is I think of this like a price chart. We get a low, we get a high, we get a lower low, then we get a lower high, and then another lower low. This is a structural downtrend. Here, just set a new low. Structural downtrend. So I'm happy about the ETFs for the long term, but this is not an attractive structural trend, and we have to be honest about the data. Brian says, how do I do puts? I buy them on Robinhood. I'm not going to teach you guys how because I am still pretty simple in the way that I approach options, and I don't want to give you guys direct trading advice. I'd rather you take ownership of your own investing because I'm still figuring things out for myself. I appreciate that you use my research as to inform you and entertain you, but I don't want to send someone down the path that I'm on because we're at different positions in life. We have entered the market at different places, and there's no way for people to trade with me real time because I'm not announcing what I'm doing in real time. So there's no reason to try to follow me. But I trade options on Robinhood. That's what I do. BT7274 says, do I have any favorite indicators? What's my favorite chart? I don't really have any favorite indicators. I kind of just look, there is a box of tools. The box of tools is all market data, and we just pull out whichever tool relates to the thing we're trying to learn about right now. When I want to focus on the health of crypto, I look at the breadth inside the crypto market. And I look at advancers and decliners and the momentum of those things and the dispersion of coins rising and falling. Same way that I look at breadth in traditional markets. So when I made that crypto view that we were just looking at, this view right here of crypto breadth. It's the same thing as me doing this and looking at the number of stocks above and below the 20-day, 50-day, 200-day moving average and the momentum oscillator of advancers and decliners for the stock market. This down here, this pair of lines down here that looks like a MACD is this. It's this, but for the stock market. It's the same exact thing down here. So I look at, that's what I look at. It's not my favorite indicator, but when I want to look at the health of the total stock market, this is one of the tools that I pull out, breadth. So it's appropriate for, whatever the problem we're trying to solve is. And if I don't have a good tool, then I make one. I code one because TradingView has a cool little script that lets us do that. Let me take a sip of my drink. BT says, do I have a short plan? So I talked a little bit about this a while ago, and maybe you heard some of that. My general plan at the moment, I have, like I said before, I have puts on big tech. And if big tech continues to rise throughout this year, then I'll be wrong about that. And those puts will expire, and that's fine because it's not a YOLO position. It is a measured single-digit percentage of my total exposure. But if it is correct, it will be worth much more than that, and it will cushion whatever losses I take as I try to mitigate my net long exposure. So I don't have a big grand short plan. I'm not going to come on here and tell you guys like Bitcoin hits 53K, I'm taking out a 25x long and I'm targeting 10,000. Like I do not operate that way. I might take a trade on a sweep of a high time frame level, but my targets will be realistic and they won't be the other side of the macro range. They'll be somewhere in the middle. They'll be something that I can actually reasonably assume to take profit at, right? So for example, like let's say we're in this range right here. I'm just using an example, right? If I had taken this trade right here, even if I think in the future that Bitcoin could break this price level, even if I think I'm correct about the recession and that this low is potentially not safe because in recessions, risk assets make new lows. Even if I believe that, only a jerk off would short here, leveraged, and target here and just close his eyes. That's not how if somebody is trading that way, more power to them. That's not how I operate. If I took this trade here, which I didn't, I told you guys I haven't taken a trade since December. I'm just holding my spot bags and I'm watching the market. But if I was actively trading this, like on a day-to-day basis, then I would target here and here. I wouldn't target this. And then if price got down here, I would watch for action at this level and I would look for another entry to trade it here. That's how I'm going to trade the market if it goes the way that I think. That is not what people think I'm doing when I post my beliefs about the economy on Twitter. People think that because I'm bearish, that I'm like max long or max short from up here, or, I'm short here, stop there, target down here. And that's no. No one trades like that. B Skeet, this is the dumbest question I know, but why can't banks just refinance those loans at the same rate they were before? Because that's not what the interest rate is. The Federal Reserve sets the interest rate, and then all other rates across all debt markets are based on that rate. Why would a bank lend to a business for a lower return than they could get from the risk-free rate? The risk-free rate, in quotes, is the rate that a bank can get from just taking money from the Fed, right? Because the Fed will always pay you. You may get debased, but they will always make payments on time. And so if you're a bank and your options to make money are borrow from the Fed because you're a bank and you can do that, or lend to the Fed, give your money to the Fed and have them pay you, or give your money to some businesses and have them pay you. The only reason you would loan to a business which actually has risks to it is if they will pay you more. So you will charge them at least the base interest rate. There is no reason you would charge them less. You are in the business of making money. Have I thought about using an ETF short like SQQQ? Yeah, maybe BT, but I didn't do that. I never traded SQQQ. I don't even know. I'm pretty sure it's a leveraged short. Yeah. Ultra Pro. So that means it's a 3x leveraged short. I think that only makes sense if you can have a really good idea of your timeline. If you don't actually know when your target is going to play out, this will destroy you. The decay on this alone will eat you alive. So you can't trade these things on a long-term short. If you have a short idea for like this week or the next couple of days, something more like that, then a 3x leveraged short ETF might be the play for you. If you're day trading off of news announcements, that might be the play. But if you're trying to short the secular highs, this is a terrible idea. Okay. We've been going for an hour and 45 minutes. I had other things I wanted to talk about, but I'm just going to save them. And we'll just do them. Maybe we'll talk about them next week. Maybe I'll do another video or something. I don't really know. But I don't want to have a 2.5 hour stream. So I want to wrap this up here soon and let you guys get back to your day. Things that I thought about talking about today, which we did not discuss. I will mention them to you guys just so we have them on the record. One of those things, the Fed decided to close the bank term funding program. It will end in March as people believed that it would. I have a couple of comments to make about that, but we can save those. They're not immediately urgent. They're just kind of some observations about these facilities and what the Fed does in times of crisis. We could talk about that some other time. There are a lot of really, in my opinion, there are a lot of really bad takes about what this means, why it's happening, what the banks are doing with this facility. A lot of bad takes. And I don't want to spend 20 minutes on this because I know that I will. But that's one thing that I thought about talking about. Another thing that's going on that, let me scroll a little further because it was just a couple days ago. Oh yeah, a lot of stuff going on in China. So, China's going through a debt deflation, and they've announced a couple of stimulus measures, and the markets are very excited about those things. Let's go look at the Chinese stock market real quick today and just see how it's doing. It had bounced. It's still continuing to bounce. That's good. 3 days of up. That's a nice bounce put in after touching some pretty low lows on the Hang Seng Index. But China's done some stimulative measures, but as I often see, I see a lot of takes that just don't really ring true, in my opinion. A lot of people think that China's going to stimulate the way they did in 2008, and we're going to have the same kind of market bounce that we got after the GFC, but that's not the setup. It's not the setup in China. You guys know what's going on over there because we talked about it 2 weeks ago. We did a deep dive into China and how indebted they are and how they got there. And they are not in a position to ease with the kind of stimmy bazooka that people in the West call for every time there's a headline about Chinese stimulus. Eric gifted another membership. Code 9 out here gifted memberships. God damn, y'all are awesome. Y'all are awesome. Single-handedly supporting the inflows of new subscribers to Alpha Beta Soup. Y'all go on if we ever have a Mount Rushmore of membership gifters, y'all are on there. Y'all are on there. David Kyra is also up there too. I might be mispronouncing David's last name, but David's up there too. DJ Lavish, gifted from Eric Martinson. Welcome. Reza, welcome. Luis XRP, welcome. All the homies. Great to see these familiar faces in here. Okay. We're going to wrap up today, guys. Talked about a lot. There's a lot going on. It's hard to capture everything in a single stream. I'm sure I missed some stuff. If there's things that you want me to talk about, make sure you leave them in the comments to the video or send me a DM on Twitter, however you want to reach out. I'll see those things. And we will get back together next week, Wednesday, Thursday, and we will do a members stream right afterwards. So every one of you with a green name will be able to come to the private stream where it'll be less of me ranting for an hour and a half and more of us just talking back and forth. I'll be able to answer questions right from the beginning. Maybe I can show you behind the curtain a little bit how I put my data together, and just I can be a little more open with you guys because it's not in the public domain. So that's what we will do next week, member stream number 2. I think this is a fascinating market. I think we are near the end of a secular expansion that has absorbed the entirety of Bitcoin's life inside of it. And I think that this year is when we find out if I'm right. That's what I think. Now, my timeline could be wrong. My total thesis could be wrong. And I won't know if the total thesis is wrong until more time has gone by. But I think this year we'll find out just how accurate I might be. Because everything has kind of been setting up for it. And just the last thing I'll say is when I talked to Blockchain Backer 3 years ago, in 2021, 2.5 years ago, and we were talking about, I watched his stream, and I also talked to him one-on-one about what he thought was possible for the markets to do. And, price was like this. And back then, the price was like back here, And back then, there were a bunch of scenarios that he talked about. I'm like, I could do this, I could do this, I could do this. And one of the things that he mentioned back then, and I will never forget it, and I bet there's a video of his from like November, December of 2021 where he actually has all these drawn on stream. And he had like all these different scenarios drawn out. And one of them was something like, it goes down and then it comes all the way back up and then that's lights out. And he had it drawn and it went to the 702. And it had this huge drawdown below the bull market lows, came all the way back up near a 702. How perfectly did I draw that? Close, a little bit overextended, but you guys get the point. And he drew something like this. And then I went, wow, that seems implausible. Back here at this point in time, I was like, wow, that seems crazy. Could we ever really do that? And then a bunch of time goes by and we actually start printing exactly that thing. And while we're printing that thing that my buddy told me about 2.5 years ago, before crypto winter, before Luna collapsed, before 3AC collapsed, before Celsius and FTX collapsed, before we had crypto's great financial crisis, before the spot ETFs were even a glimmer in people's eyes in this particular cycle. Then we started setting up for a recession. And those things started setting up during the downtrend. And when I started lining up the potential timelines for when a downturn is most likely to manifest based on what the US economy has done in the past, I started to come together with a timeline that resembled something in this period here. Let me make this a yellow box. Let me make sure I get this accurate. Somewhere in here. Late 2023, Q4 of 2023 through 2024. Namely the first part of 2024, but it could be any time during that year. And so this is literally where we are. We're in this box in terms of when economic outcomes tend to resolve. The price chart has perfectly set up on the tail risk scenario that my very good buddy outlined for me 2.5 years ago, and it 100% overlaps with a possible recession that is taking really long to manifest and that I think is going to catch a lot of people off guard. And when I overlay those two theses on top of each other, it is impossible for me to turn away, while the data continues to support this playing out. So when people get mad at me that I still sound bearish, there's a good reason for it. And it's because I have been watching this set up exactly this way for 2 years. It's like there is some kind of a magical puppeteer making all of this happen. It's almost inexplicable to me. And then, are you kidding me? We get to this moment right here. And what happens? The biggest holder of spot Bitcoin that has locked people up for years, that has pissed off every single one of its customers. I'm talking about Grayscale. I'm talking about GBTC. They have had people locked in their instrument for fucking years. They had their holders sue them for mismanagement. These people want out. And not only do those people want out, but many of those same holders went bankrupt during this period of time, which came after the period of time when my buddy drew this fucking fractal. And we get to this point, and that instrument lets all of these people free. And not only does it let them all free, but it keeps a management fee that is 2 and 3x higher than every one of their competitors. It is the most perfect reversal setup I have ever seen. It swept a 2-year high. It swept the 618 retracement, all at the same time that it released multi-year angry bag holders while keeping a management fee that blows out the competition and makes people want to leave. While we still have a recession setup forming economically, and beyond all comprehension, businesses and households are refusing to refinance. They've raised rates, and we haven't even gotten to the point where the economy is functioning there, which sets up a really disgusting potential rug pull in people's expectations for what the near-term future could look like. So yeah, my bias is unchanged. So yeah, I am sitting here going, are you fucking serious? We've been watching this play out for this long, and we get to the retracements, and Grayscale opens the gates with a 1.5% fee and a bunch of bankrupt estates holding their asset? Unbelievable. Unbelievable. Truly a unicorns and magical fairy dust situation. And not only that, but if we just happen to get lucky and we press just a little bit higher in order to allow Ethereum and some of the others to catch up with this move, because the whole market is an organism, right? And it's very likely that they will need to catch up at some point. Where does that send the Bitcoin market cap? Literally. It literally sends it to the 1 trillion level. The level that is so perfect, that is so mathematically perfect, that the 702 has 2 zeros after the decimal point on the $1 trillion market cap. 1.003 trillion is the 702, which is 53K. That's what that price is right there. My spidey senses are tingling, friends. Full body spidey senses. That's where I sit today. Holy shit. The activity has just exploded. Eric gifting even more memberships. Code 9, Ryan Rendon, David gifting memberships. There's going to be a day when we all get together somewhere and I'm going to have to buy like 3, 4, 5 rounds of beer just to make up for the deluge of generosity flooding this community right now. I'm going to have to buy multiple rounds of beer. BT, thank you for the donation. He says, you're awesome. Love the charts and input. Thank you. Thank you for giving me a platform to share my opinions. I really appreciate it. This is cathartic for me. I sit here and I look at all this stuff and I don't have anyone to talk about it with, except for BCB. He's probably tired of hearing me say shit all the time. He's like my only market friend. Yeah. This is where I look at. It's unbelievable to me that this is all set up the way that it has. I outlined everything for you. It's fucking crazy to me. Rational Evidence says, thank you for clear articulation. You're the only one I can watch on 3x speed because you don't slur your words. I do not slur my words. That's what I get for having a mom who was in theater. What if you don't drink? Well then, Coin DeFi X, I will be buying you club sodas with a lemon garnish. And also, Rational Evidence, you watch me on 3x, bro? Holy shit. I can't watch things on faster than 1.5x. Because I just gotta I gotta process it, you know, I gotta think about what I'm listening to. I can't listen to anybody faster than 1.5x. But I appreciate that. I take it as a compliment. Okay. I ranted a little bit more than I thought. I kind of summed things up for you guys. So I'm gonna let that cap the end of the stream and we'll let you go for real. So next week we'll do the public stream and we'll do the member stream right afterwards. I look forward to seeing all of you there. Everybody who was just gifted a membership, from Eric, from Code 9, from David, from Ryan, all the homies that were so generous today gifting memberships, you have now opened the door for a bunch of our friends to join us next week on the member stream. So I look forward to seeing all of you there. If you have any questions, DM me on Twitter or leave comments to the video and I'll see them. And I hope you all have a great weekend. So until the next time, take care of yourselves. Take care of your friends. Take care of your little furry pets. Give your mom a call. Touch grass. Don't listen to people that tell you that Bitcoin's going to 1 million a week after the ETF launches. And we will chat again in just a few days. Cheers, everyone.